All right, so what matters most? So we've got two concepts that we're going to lay in here at the top of this, of your blueprint. You've got a copy of this, so you've seen it, but the first is capitalize to viability. So what exactly do we mean here? So it's really important as we run into this season, whether it's another 30 days, 60 days, 90 days, and then dealing particularly with the economic fallout that is going to transpire based on all accounts, is that we are appropriately capitalized. So 3 areas to really think about when it comes to capitalization: debt, equity, and working capital. So debt is imperative that you have access to resources in order to sustain the business through this time. Obviously, real estate, if anybody went through the Great Recession, banks really arrived at a place where, for all practical purposes, their lending was against hard assets, real estate, and marketable security. And so, praise the Lord, this has been a very different season. It seems like within just the first couple of weeks, bankers were calling clients in many respects and offering to do 90-day deferrals of P&I and letting it accrue and either re-amortize and or just defer it in general. And that is just an amazing extension there. And so having that conversation, that's one of the things down there with your banker is very important, talking about deferrals. Debt generally is going to be cheaper than equity. So keep this in mind as we go through this conversation. We want to use debt during this season potentially to purchase margin producing assets. We're going to spend a lot of time talking about making decisions at the margin. What that means, as we talk about that today, is that margin producing assets or margin, positive margin, is any decision that actually creates marginal positive impact. So if you look at the revenue impact and compare the cost associated with it, it is a positive margin decision if that is a positive differential. It would be negative if the associated revenue is less than the associated cost. And so in this scenario, purchasing an asset that is going to create positive margin. Risk is always a consideration here, especially given the fact that if given the world of personal guarantees, et cetera, great risk can be at play here. So you need to make sure you make that part of the decision process. So equity strategic versus survival. What this means is generally when we're looking for equity infusions in a company, we want these equity infusions to be strategic. And so right now the temptation in this season is to plow money into a company in order to ensure survival. But really, we need to make sure we're doing all the other things before we do that, because we don't want to throw good money after bad. If the company, for some reason, needs to reorganize, you don't want to reorganize that with those outside assets involved that have been reinvested in something that maybe was not viable as currently structured. So we need to go through these other decisions first. Engage ownership. This is a really important key. One of the things that I talked to Claude about this weekend, Claude Sr., who many of you know, my dad, and that's his name on the wall, not mine. But I said, Dad, I'm going to need you to make some phone calls this week. He's really excited about doing that. And engaging these amazing leaders that oftentimes have started a business and or led it, maybe during these times of plenty, they may be backed out. This is a time for owners to not only become engaged, but to engage them. They have amazing resources to be able to play. This is the season to step up and become a part of what lies ahead. We'll talk about that a little bit in conclusion here. Quasi-equity, these are things like warrants, et cetera. Be considerate of those based on the performance and the outcome, much better than just giving away pure out equity. Reinvestment, and again, the risk around this, as I talked about earlier, if we just plow money into the company without doing these other things that matter most, prior to that, we are putting good money after bad. That is the real caution in this point as you think about equity injection. Working capital, we have a great in our triple P. I'm sorry, in our let me move. This is getting blocked by my screen here, so let me get the video blocks down. Working capital, we have an amazing write-up in our toolkit. Larry, thank you for doing that with all your background in the banking world. That is a great guide. You need to defer AR. You need to defer AP whenever possible. Take advantage of terms. Potentially consider discounts for AR receipts from your customers. Inventory, look at your inventory turnover rates. If you're not moving a lot of a product, don't restock on it. If you're a manufacturer, don't make more of that. Put your resources in play for the things that are creating the most liquidity at this point in time. Consider sales to get rid of stagnant inventory or slow-moving inventory, potentially during this season. Line of credit, consider that for your timing issues. So deploy to margin. What exactly do we mean when we say this? We're talking about expanding staff and spending that is greater than margin neutral. So in other words, we want to spend our resources on those things that are creating positive margin. Equally as much, that next point there is about not spending our resources on those things that are less than or equal to margin neutral. In other words, as I mentioned earlier, we're spending money on something that is creating less revenue. And then lastly, reorganize. We'll come to that. So when we talk about expanding staff and spending around greater than margin neutral, that means that we're going to put our resources to play. What we need to do as organizations is take our dollars, and they need to be expended all the time on those things that are creating positive margin. These are core producers, key employees, reward leaders and performers, particularly in this place. And I would say performers is even more important to reward during this period of time, those folks that are creating that margin. And then replace the underperformers. So during this season, unfortunately, if you have someone in this space that is underperforming, it is really important to look at that and adjust it and have that hard conversation and deal with it. The next point here, and this is hard, we're going to come to this in a little bit, but making decisions around team members. First of all, if they are not margin positive, consider redeployment. Is there a way you can redeploy them into an area that is margin positive? We're seeing this all over the place. Potential suspensions, separations need to be a part of the menu. We're going to talk about why our government has made that a lot easier. Constraints. What this means is ultimately, sometimes, especially in this Nashville market, it's been really hard to get good people. And so you've got to consider what that means. Sometimes that might mean helping them get through an unemployment period or a furlough type period with upfront dollars, and then to retract them back with the differential on the back end. So consider making whole if that differential is a number that needs to be made up through unemployment, et cetera. And then lastly, reorganize with no path to the margin, emergency action plan. That's what EAP means. So if there is no path to margins, if you're only negative, it's very important to consider what options you have there. One is find new revenues. We have clients that have spun up other activities. One, I think of a distillery that's making hand sanitizer. I think of folks that have switched the products that they're manufacturing in our client base. And of course, we're hearing about this all over the nation. Consider new revenue streams, whatever those might be for you. Use that entrepreneurial spirit. Divest, potentially, if we have things that to other folks might be attractive during the season, but is not working well for us, consider divestiture. Sometimes the answer might be just to freeze. We have many clients that are making this decision right now, and oftentimes, depending on if there is not this path to positive margin, freezing is the right answer. And then to merge, potentially. There might be someone else that's out there that is in a similar spot. You can find some synergies and strategic initiatives that can find cost savings, et cetera. And that is a last resort, obviously, but is something that some of our clients are considering and is a thing on the menu always, and is even more so on the menu potentially today. All right. So across the bottom, this is what we're going to start getting into right now. We have an amazing process of these blueprints. I'm looking forward to start getting into these. Larry is going to hit Triple P for us here as we get started. We will come back to these after we have run through these blueprints. So Larry Clume, thank you so much. We have given you a new middle name. I'm not even exactly sure what the official middle name is, but it's Triple P now because Larry has become literally might be a national expert in this at this point in time. So Larry, I'm going to let you take it away. Run us through the Triple P blueprint, sir.
Great, thank you, CJ. The Paycheck Protection Loan Program is really a fantastic program that Congress and the President came up with in the CARES Act, which was enacted, hard to believe, all of 10 days ago. But this program is going to provide $349 billion of potentially forgivable loans to small employers. And the way the Act goes about this, they define a small employer as one of those that has fewer than 500 employees. program has been expanded beyond what the Small Business Administration typically would lend to. So entities, non-for-profit 501c3 organizations are qualified, as well as veterans organizations. And something new for SBA will now lend to, for this program, small proprietors, sole proprietors, and independent contractors. So basically how does the program work? The loan amount is up to 2.5 times the entity's average monthly payroll cost for calendar year 2019. And for this purpose, payroll costs are going to include your wages, salaries, commissions, as well as your employee benefits, which would primarily be your group health care and retirement benefits. Now, for any individual employee who has wages and salaries greater than $100,000, that excess amount, the amount over $100,000, is not going to be included. So that's how your lender is going to determine how much you're eligible for. Once we calculate the average monthly payroll costs, it is multiplied by 2.5 times, and that is your loan amount. Then the question arises is, well, okay, I've borrowed this money. What can I use it for? And what portion of it will be forgiven? Well, the loan can be used for 5 different purposes, and these costs have to be incurred during a period of time between February 15th and June 30th. And those 5 purposes are payroll costs, like I just talked about, mortgage interest, rent, utilities, and interest on other indebtedness that you incurred prior to February 15th. And again, those costs must be dispersed between February 15th and June 30th. We have a different period of time when we start contemplating how much of the loan can get forgiven. So the amount of the loan that can be forgiven is the sum of your qualifying costs that are incurred in the 8-week period following the day you get the loan. And it's a slightly shorter list of qualifying costs. The costs can be your payroll costs, mortgage interest, rent, and utilities. In this grouping, you cannot include interest on other debt. Also, your payroll costs must be 75% of your costs for forgiveness. Only 25% can be those non-payroll costs, mortgage interest, rent, and utilities. So when you go to calculate how much can be forgiven, you'll tally up these 4 different costs. That is the amount. So if you've borrowed $100,000 and these costs that you've dispersed over that 8-week period are $90,000, your maximum forgiveness can be $90,000. Once you've calculated the qualifying cost, you then have to apply 2 additional reduction tests based on your full-time equivalent employees compared to a base period. So if you maintain your full-time equivalent employees during that 8-week period, you won't have a reduction. If you've reduced your number of full-time employees, you'll reduce your forgiveness by a ratio versus a base period. Then you'd move on to a second reduction factor, and that is for any employee who has experienced a 25% reduction in wages or salary compared to what that employee was paid in the first quarter of 2020, you'll have to deduct that dollar for dollar off your forgiveness. Now, for this purpose, we're only going to include your rank and file employees. So those are only going to be employees who at no time during 2019 received compensation in excess of $100,000 on an annualized basis. So again, you kind of get the flavor of what Congress is trying to achieve here, and that is they're really encouraging small business to try to retain their employees with the use of these loan proceeds.
That is an amazing summary, Larry. And over the course of the last little bit, and again, on the website actually is about a 30-minute recording of an internal training we did on Triple P. So for details around that, please feel free to go and look at that. Also, keep in mind, if you do have questions, please just put them in the chat down low, and our team's going to answer them throughout the course of this time. But one of the big things that we found through this season, Larry, is this has been a wild ride for the bankers.
Yeah, as I mentioned, the CARES Act was only enacted 10 days ago. And this provision in particular asked an enormous challenge to the banking industry to get up and running and accept loan applications and fund these from millions of small businesses across the country. So we saw last week, and particularly on Friday, there was a lot of frustration, a lot of administrative problems that emerged, a diversity of practice across banks as to what documentation they were going to require or not require. Many banks are still not in a position yet where they're able to accept loan applications. What we've experienced is, and this is an interesting take of it, is that your smaller community banks that are using less technology were the ones that were able to accept a loan application quicker. When you actually drove up to the bank and handed your application through the drive-in window to your banker, those got processed. The larger banks, which by necessity have to use some kind of technology, an online portal, those were more challenged because they were trying to bring these portals up to speed in a matter of days and have them such that they could accept applications from hundreds of thousands, or even in the case of our largest banks, millions of small businesses. And there were a lot of difficulties on Friday with businesses trying to get applications submitted. I did see a report in the Wall Street Journal this morning that on Friday and Saturday, banks across the country processed applications totaling $30 billion. That's a little bit less than 10% of all of the appropriated funds for this program. So as the week goes on and more banks come up, it's likely that everyone's going to be able to get their application submitted.
And as that transpires, you know, we've talked about this as Pamplona for the bankers, like the running of the bulls, because it has felt a little bit like a run on the bank, given the limitation on the funding that exists right now. But we're hearing some different news out there. But do you mind just sharing, Larry, the economics, the reality of it as far as the demand for this versus the current supply, and what leaders are saying right now?
Well, CJ, because of the situation that we're in and the attractiveness of this program, I think that every small business in the country is going to want to get one of these if they qualify. I really don't see a reason why you would not want to get these funds. First of all, you may ask the question as well, what happens if I don't meet the conditions to get forgiveness? Well, step back for a moment and look at the loan that you're getting. And this is a more attractive loan than you could get in normal circumstances from your bank. The portion that is not forgiven is going to have a 2-year term of maturity with a 1% interest rate, no personal guarantees to the business owner, and it's unsecured with no collateral required. The first 6 months of loan payments are going to be deferred. This is a loan that we would not be able to get under normal circumstances from our banker. And then throw on top of that the fact that if you do have qualifying disbursements, you may get all or a significant portion of the loan forgiven. So everyone's going to want to do it. The article I saw in the Journal this morning indicated that Chase itself, just one bank, has over 4 million small businesses. So you can imagine what an enormous task this is.
Absolutely. And, you know, I saw where basically Wells Fargo has filled up their coffers, so to speak, and they've done all that they're going to do. And so it's going to be a very interesting season ahead to see when this potentially runs out, and then the additional funding that Congress is talking about, what that looks like. But it is an amazing program, and it's one of the things we sent out to the client base on Thursday saying, you have to do this. And it is imperative. If you are eligible, generally speaking, consider going for this, and because the provisions are just really quite spectacular.
Yeah, one of the things we've had a lot of clients very anxious about this because the concern being that the $349 billion appropriation is going to run out pretty quickly, and I think that's probably true. The good thing here is that members of both sides of the aisle have come out and publicly said that they will support expanding this appropriation if the money runs out. So last Friday morning, Speaker Pelosi said yes, she'll do it. President Trump has said yes. So while we encourage everyone to apply as quickly as possible, I think you can kind of reasonably have in the back of your mind that even if the $349 billion runs out, it's likely that Congress is going to increase that number with the next bill.
Absolutely, and there's been a lot of conversations around the eligibility of independent contractors versus, traditional businesses, and the timing, particularly with the guidance that quote self-employed would be coming out this week. This Friday would be eligible for applications. Specifically, that is more, as we have interpreted thus far, independent contractors. But banks are taking different perspectives on when they'll take applications and for what type of entity. Are you seeing that, Larry, as well?
Yes, there's been a lot of diversity across banks. The banks, based on what they will accept as payroll costs, as well as what documentation they're requiring. There was a lot of debate last week about whether independent contractor payments made on 1099 MIS were going to qualify. And after close of business on Thursday, the SBA came out with final regulations pretty clearly defining that payments made to 1099 contractors are not included in your average monthly payroll costs. So then with respect to the banks, we've seen some banks ask for an enormous amount of information and others a more sparse checklist. SBA came out with guidance on Saturday, guidance for the banks saying that the borrower is primarily responsible for calculating the average monthly payroll costs. Yes, the bank should obtain copies of the borrower's filed payroll tax returns, but the bank has no obligation to go in and do an analysis or verify what those costs will be. So again, we'll have to see how the banks respond to this. It may be that some of the banks that were asking for the most information will, scale back a little bit what they're asking for. But my advice to everyone has been, whatever your bank asks for, you should give it to them. Because in this environment, the most common thing we're hearing from bankers is, hey, we're having a hard enough time taking care of our own customers. We're not going to offer one of these to someone who's previously was not a customer of the bank. So the best course of action you can follow as a business owner is work with your bank and submit the documentation that your bank is asking for, even if you think they might be a little excessive in what they're asking for. Probably best to work with your own banker.
That's great wisdom, Larry. It is, and definitely start with your banker. If for some reason they are not, please reach out to your CPA here at the firm. And if your banker doesn't already have a source that they're utilizing, we'll help try and get you connected with a couple of banks are opening up to outsiders, but it's going to be, it is literally Pamplona for the bankers. And so to reinforce what Larry is saying, really be patient with your bankers and understanding through this season. Give them what they need, whatever it is that they're asking for around this. And then just kind of in closing, I want us to make sure and we think about before we move on to the next concept of what does this actually mean in perspective. So when I get this loan, everybody, I've heard so many clients talk about, well, I'm going to bring back every employee that's been furloughed and just pay them for the next 8 weeks, even if they're not working, et cetera. So one of our concept here that I want everyone to walk away with as a business leader is, first, if you get a PPP loan, one, spend to the compliance levels. Larry talked earlier about the 75-25 rule that came out. Again, this has been moving all over the place. This interim final guidance, finally, we started seeing the 75-25, which was not in the bill. Concepts start showing up in early versions of applications, et cetera, and then it came out late Thursday night in the interim final. That's almost an oxymoron in itself, the interim final rules. And in this compliance period, which we believe right now is 2/15 to 6/30, it is imperative you spend to compliance. Otherwise, your loan is out of compliance, and that opens up a whole nother can of worms we're not going to get into. But then after you've spent to compliance, then forgiveness is really a secondary consideration based on the appropriate staffing models and, again, this positive margin concept that we keep coming back to. And so it is really an integration effort. And that is our point down there. If you look between comply with loan requirements and loan forgiveness, we need to deploy the capital to the margin, make sure we meet compliance. But then second to that, forgiveness is second to liquidity and the continued operation of the company. Because if you just spend in order to get forgiveness and you're not strategic in these dollars, potentially we're just serving basically as a conduit for unemployment. Instead, we want to make sure we're being intentional to make decisions around these expenditures that are based on achieving long-term viability for the company. Well, Larry, did you have any last thoughts before we move on to our next slide?
Yeah, your last point, CJ, was really well taken. It's really a two-phase decision process. Number one, should I get the loan? And I think if you presented this loan to any business owner in regular times, they'd say, it's so attractive, I've got to get the loan. But it's really attractive when other funding sources in this crisis aren't available. But then the second question is, should I do the things I need to do to get forgiveness? And unfortunately, the answer is not always, yes, I'm going to pay my employees. Because if your business closed, you're operating a gym and you have no revenue. If you take a $100,000 loan and turn around and pay your employees $100,000 and you get 100% forgiveness, at the end of all of this, you basically have just acted as a conduit for the government. You don't owe anything, but you don't have any cash either. So that second decision matrix is a little more complicated than the first. You want to get the money, and then you want to think about if you want to spend the money in a manner that's going to get your forgiveness.
That's exactly right, Larry. Well, again, thank you so much, Larry. And for any of you who have not, I mentioned earlier, but not only is the video on the website underneath News and Triple P, but also an amazing write-up that Larry has championed surrounding the details based on the bill. Things have moved and changed. We've tried to keep that adjusted, and we'll probably need to do a revision on it midweek based on guidance that came out over the weekend. Nothing materially has changed, but please, between watching that video and reading the article, that will give you the information that you need to proceed in these discussions with your bankers and understand the concepts behind this. Larry, thank you so much. Again, appreciate it.
Thank you, CJ.
All right. So the Families First Coronavirus Response Act. This was take two. So Congress has had three big bills in this process, and a fourth one is forthcoming. The first one dealt with some medical. This Families First Coronavirus Response Act was a big deal when it came out, still is. And this is a sustainable one. So in CARES, there's several things we're going to talk about that do kind of go on for a long, but this lasts through the end of the year. And so this is a concept that really needs to be laced in to all of our employers and their decision making. And it can best be boiled down. Well, before I really get into the details around that, just if anyone has not read, this is on the website as well. Got a great write-up in there that describes these in great detail. This has not been as much of a moving target, thank goodness, as the Triple P particularly has been. This is pretty well set. And it really gets into two main areas. There's several different sections to the bill, but the biggest two areas that we've focused on is the expansion of the Family Medical Leave Act and a new concept called Emergency Paid Sick Leave Act, EPSLA. And these provide for payments to employees under certain scenarios. We're going to cover those on our next two blueprints. And specifically, credits associated with these. It can best be boiled down around either one of these provisions is a decision. First, if you look at our boxes across the top of this Blankenship Perspective blueprint here on FFCRA, is are you a covered employer, first of all? If the answer is no, then you just let people know they're not eligible for it. So if you are a covered employee, and look at the red box over here on the right, but you are not eligible for credit, what this is going to basically mean is this is pretty much going to be negative to your margins, generally speaking, with the exception of a really good RMR, recurring monthly revenue type arrangement at the business. And our advice here is post and comply. All right, there are significant provisions around results and consequences if you do not comply. So make sure you're in compliance. And specifically, it's a violation of either the Family Medical Leave Act and all the provisions that come along with that, or a violation of failing to pay minimum wage for the EPSLA. And so what does this mean then if I am eligible for the credits? That's our green box in the middle. Then we want to ask ourselves really three effective questions. Does this potentially provide gross margin opportunity? So am I able to maintain revenues with a reduced workforce? Do I have a decrease in revenue and need to decrease the workforce? Am I effectively shut down? So if the answer to those are no, then post and comply. If the answers to those are yes, then it's post and promote. And specifically, what does that mean? It means educate employees, liberalize the application, and supplement the utilization. Make it worthwhile for team members to take advantage of this. Because ultimately what that will do is create margin to help sustain the company through this season. So specifically, what do these two different provisions mean? Ben, if you don't mind, go ahead and adjust. Let me just add one more concept down here, process credits. Because there are credits associated with these, the credits actually run through the payroll process. That payroll process itself includes the normal payroll tax deposits that are filed according to the schedule based on your payroll amounts. And so what you normally do from a processing to create instantaneous liquidity around these concepts, if you're eligible for the credits, you reduce those payroll tax deposits. Once you have fully worked through those deposits, it becomes treated like an overpayment. And if you've gotten to that level quickly during the filing cycle, there's a new form. It's called the Streamline Form 7200, which allows you to go ahead. So if your normal payroll tax deposits were to be, $100,000, but these credits have accumulated to $150,000, well, now you have a $50,000 equivalent overpayment. So normally that would have just been processed through the normal 941. But given the current need for liquidity, there's the Form 7200 that allows you to get those dollars today. So you have to adjust this payroll process. Very important if you're into the post and promote areas. All right, Ben. Wonderful. All right, so Emergency Paid Sick Leave Act. This is a brand new concept. It basically allows for 10 days of paid sick leave. That paid sick leave is going to be in one of these two categories you see on the slide there. I call it doors 1 through 3 and doors 4 through 6. So doors 1 through 3 basically allow where if, and you can look and study those yourself, but basically you are directly encountering the coronavirus. If that is the case and you fall into one of these three categories and you are not able to telework, this is very important. Unable to telework is a new concept that came out in the bill. I'll pause for just one moment to say that the original version of this bill was candidly just quite scary. I was super concerned it would literally kill small businesses. It did nothing but actually cost monies. The wages were subject to Social Security and Medicare. There was no credit for that. There was not a limit on the amount of wages that would have bnow paid out, whereas there was a limit on the credit. This was a terrible bill. They fixed all that. It was great news. And as they fixed it all, now it is a great program. So you get through these first three, and the maximum amount of both the credit and the wages is the lesser of their average daily rate, or $511. Now, if you're in doors 4 through 6, it's the lesser of 2/3 of your average wages, or $200 a day. And doors 4 through 6, generally speaking, are taking care of someone, with 6 being a little add-on. 6 was not in the original bill. That has some slightly different provisions that we can't get into today. Emergency Family and Medical Leave Expansion Act is basically just an expansion of the EFM, of the Family Medical Leave Act. This is the normal rule of if you need to take care of your family, you have 12 weeks to potentially do that, of unpaid leave. What this act did is it changed from 12 weeks of unpaid leave to the first 2 weeks of paid leave, followed by 10 weeks, the first 2 weeks of unpaid leave, followed by 10 weeks of paid leave. So the amount of that paid leave, and again, this is not the normal family medical leave. This is if it is associated with COVID-19, and there's very specifically, it got pulled down. It originally had the same, in the original bill, the same 5 concepts over here on the left, but it was pulled down to only one concept, and that is concept number 5, which is your employee. You're basically taking care of a child who is not in school or whose child care provider is otherwise unavailable. And so you get through these first 10 days of unpaid leave. You can coordinate other benefits with that. An employer cannot force someone to use other benefits. And then you get into the paid portion, which is going to be either the lesser of 2/3 of the daily average wages or $200 a day. And so with both of these, conceptually, what we're working on here is if these concepts are out there, you have people that are, not quite fully utilized, or you have a recurring monthly revenue model that is sustainable. What you want to do is you want to turn around and turn this on at the margin. That way you can create incremental profits at the bottom line to be able to take advantage of this to otherwise sustain the company through what is going to be clearly a rough patch for so many of our clients. And so these integrations into the plan, these are great benefits that if appropriately handled, if you're eligible for the credits, can be a great benefit. So we have these in the blueprints, and then we have some great Q&As that follow this. All right, unemployment insurance. So I believe Karen is going to cover a couple of these concepts for us. If not, Karen, I'll be happy to, but I think that you're ready to talk about these.
I'm ready.
Wonderful. Great, Karen. Well, go ahead and let's run us through this, unemployment insurance concept.
Sure. Okay. Real quickly, the overall premise here is that unemployment insurance has been expanded. So normal unemployment, for example, in Tennessee is paid over a period of 26 weeks up to a maximum of about $275 per day. With the expansion, there's an additional $600 per week supplemental that's paid on top of the unemployment compensation for those who already would have qualified under state unemployment rules. In addition, there is expansion for pandemic unemployment assistance. So for those who wouldn't have normally qualified under normal state unemployment rules, they're going to qualify under these additional rules. And again, that rate is going to be the normal state unemployment rate plus $600 per week for the unemployed worker. It's through July 31st, 2020, and there's an extra 13 weeks. So bringing that total maximum up to 39 weeks. And then another expansion of this is that it does apply to self-employed individuals, independent contractors, and those with limited work history who normally would have either not qualified or qualification would have been different under your typical unemployment insurance rules. And then the last item there, self-certification in COVID-19. Again, the rules, the 1 through 6, diagnose within your household, you're caring for somebody, quarantine, or quit as a direct result of COVID-19, or the business is closed, that type thing. So just generally speaking, an expansion of the unemployment insurance. And again, another opportunity to determine if you've got margin to consider here and how this might be part of the blueprint. So I think that's it.
That's great, Karen. Thank you for that summary. And, you know, this is a hard conversation. And as we built this blueprint particularly, it ended up actually looking like a house. And, you know, I'm going to pause on that for just 1 second. Anytime we talk about taking care of our employees, I mean, this is a hard conversation. But you do have to take care of the house. Otherwise, if you don't take care of the house itself, the company is not going to be in a position to survive and emerge from this potential, you know, just a very, very difficult time for so many of our clients. I mean, I've had some conversations with clients that have started around the lines of, you know, CJ, we've shut our doors and I don't, you know, we're shut down until this thing gets out. Well, in the meantime, they have all their fixed costs, et cetera, that are having to be dealt with. And employees are furloughed and or separated. Other clients have said, CJ, I think I can get through this. You know, I was expecting a 50% drop in my sales. You know, my sales just went down to nothing. And I mean, these are difficult times, but it is imperative that we balance the survival of the company itself with taking care of the team members. And everything that Karen just went through really makes some of these decisions a little bit easier. It's one thing if you have to furlough an employee or let someone go at $275 a week, but with this extra $600 a week on top of it, assuming that they will qualify under the COVID-19, which generally speaking, most folks will, then it's a self-certification process through there, then it makes this conversation a little bit easier for the time being. Because the important thing here is to look again on what it is doing to the company as a whole. So if that employee is less than or equal to margin neutral, if it's no, then your first question is, can you redeploy? If so, then we move back to the right side. If we can't redeploy, then we have to consider what it looks like to integrate both, you know, these expanded benefits with separation. You've got to keep about the triple P compliance aspect of things. Again, not the forgiveness necessarily, but the compliance aspect of things in this scenario. If they are less than or equal to margin neutral, meaning they are costing us money and not putting anything to the bottom line. And then we've got to consider return incentives. So coming back to the constraints conversation earlier, if a team member does have great value to the company, then think about what it takes to get them through the period so that they're not negative. So for instance, if they were making $1,000 a week, now they're going to get $875. Well, consider what it means to make them whole for that, either on the front end, and that can potentially get laced into that compliance concept as long as it falls in the 8-week period following the funding of the PPP. And then consider return incentives, particularly of what it means to make up that difference on the back end, so that they do come back to the company and get re-engaged when we get through this and we're able to open the doors back up, and hopefully we have just some pent-up demand that explodes. So getting to the other side of here, if an employee is margin positive, they are doing good, they're creating bottom lines, net bottom lines for the company, help covering that fixed cost, basically. And so this is where cost accounting becomes so imperative, to understand what is your cost associated with every team member and with every activity, and then what is the associated revenue, what is that margin increase. And so if they're not fully utilized, consider the rolling furlough, integration with the PPP, obviously, like we have talked about when it comes to compliance, return incentives as well. And also underneath here, it's really important, we've talked a little bit about the FFCRA previously. That FFCRA is a great concept to lace in here if they are not fully utilized. And then if they are fully utilized, it's very important, we always want to make sure that our compensation programs are aligned. So if they're fully utilized and they are making positive margin, we got to make sure that they are taken care of during this period. They need to be incentivized to continue to perform well. And then we've always talked about it, the firm as part of our What Matters Most model, is to align compensation with performance objectives and great outcomes for the company. So that becomes even more important now. When somebody continues to increase and or produce to the margin, it is imperative that their compensation is aligned with such. All right, well, Ben, why don't you run us through the EIDL? There's a lot of conversation around these, around the EIDL loans, and particularly what this program means. Do you mind giving us a quick purview of this, and then we're going to hit a survey of other provisions and come back to our blueprint?
Yes, thank you, CJ. The EIDL loan was in existence for a long time. The CARES Act came in and expanded the eligibility in terms of those who qualify and those eligible uses of the funds, and it introduced a $10,000 grant, which is a loan advance that's not required to be repaid. Those expansion provisions in the CARES Act generated a lot of media and a lot of interest in this loan. And while this loan may be potentially a really great option and a nice loan for a number of our clients, I think our advice at this stage is to keep your eye on the prize, which is to pursue the PPP first, and don't do something that would jeopardize getting the PPP while going after the EIDL in this week. After we know where we stand on the PPP, take advantage of the $10,000 grant if you can qualify, and then come back and look at the EIDL. This is a loan that has really nice terms to it, and which should be discussed along with your banker, along with other lending options that they may have. For those who receive the funds, it is important that we integrate the spending plan along with the PPP. There are a number of interplays to be considered, and at concept here is no double dipping. And there's a 237-page document that is guiding on the uses of this loan, along with the provisions in the CARES Act. So if, for those of you who do end up getting this loan, make sure you're talking with us around how it is being spent, so that we are making sure we're in compliance with both the PPP and the EIDL.
That's great, Ben. And then do you mind just giving us a quick summary of some of the, this is a restrictive loan. This isn't something that is just, you know, the $10,000 is one thing from the $10,000, which is basically forgivable. It's like a grant at this point in time. It does have integration with the PPP. But when it comes to that residual balance, there are some really specific guidelines for the EIDL as far as the loan amount, what those funds can be used for. This isn't just a slam dunk.
Absolutely. These funds are not to be used for various restrictions on compensation to owners, on purchasing of new assets. It has been expanded to include some working capital provisions, but overall significantly restricted uses for how these funds can be deployed.
That's right, Ben. And it is amazing terms. You can see down there 3.75 for small businesses, 2.75 up to 30 years based on the ability of the company to repay. But there are collateral considerations. Basically, this is traditional SBA, so to speak. They'll take a position on your house. And so after $25,000. And so this is something that's out there, especially the $10,000. Once you get through the PPP, most likely the $10,000 you're going to be eligible for under the CARES expansion. So look at that, as Ben said. But proceed with caution. Understand it. There's 200 and some odd page. What was it? 270 something, 6 something like that. Standard operating procedure for this EIDL loan. It is a big deal to comply. So consider that as part of your process. So thank you so much, Ben. Appreciate that. Paul, our tax director, is going to talk a little bit about some consolation prizes for those, and he'll explain what that means, as well as some of the other great provisions that came into this CARES Act that was passed literally, last Friday and signed last Friday night.
Thank you, CJ. Good morning. So just a couple of the other provisions that came out of the CARES Act. Maybe one of the bigger ones, in case you weren't able to get the PPP loan, is an employee retention credit. So to the extent you're able to retain employees, the credit is 50% of the wages up to the first $10,000 of the wages. So a pretty nice credit available. There are quite a few limitations depending on the size of your business. So a business with 100 or fewer employees, all compensation to all employees would be eligible for the retention credit. If you're an employer over 100 employees, it's only to the extent that you furlough or have reduced employee hours for individuals that would be eligible for that credit. So, if everything else is lost with the PPP, maybe a consolidation is the employee retention credit. Hopefully, we'll have some more regulations around that in the few next coming days to give more clarity, but would be available for employers. Also, if you were ineligible for the PPP loan, there's a payroll tax deposit timing issue that you might be able to play with. So to the extent you have employer side of the employer taxes, Social Security and Medicare, there's a deferral on making that payment until December 31 of 2021 and 2022. That would be 50-50 payments on those two dates. So again, just in the nature of trying to keep cash in pockets of employers, a nice little deferral could potentially be available. Some individual provisions in the CARES Act. We've all heard about the rebate, so I won't spend much time there. But also some liberalization around the retirement plans and the ability for withdrawals and loans. So under existing rules, there was a $50,000 loan limit on accessing 401k plans. That's been expanded up to $100,000 through the CARES Act. Also, anyone that was affected by the coronavirus, as they call it, a coronavirus related incident, there's a $1,000 distribution that you can take from your retirement plan that you can either contribute back the money over 3 years or take that into taxable income ratably over 3 years. So again, giving individuals access to money, very important during this time. A couple of business provisions that we probably want to mention. Net operating losses, to the extent businesses had those incurred in 2018, 19, or 20, can be carried back 5 years. So again, hoping to put money back into the pockets of individuals. And finally, I'll mention the QIP, the Qualified Improvement Property. This is real property improvements that were made outside of the acquisition of real property. These were eligible for bonus depreciation under prior law, but the Tax Cut and Jobs Act, poorly written, I guess we'll say, did not allow for bonus depreciation on the QIP property. So that was fixed with the CARES Act. So to the extent you have qualifying property that was placed in service after 2017, so in 18 or 19, you can go back and get the bonus depreciation for that. So hopefully that will help out taxpayers through these provisions. Back to you, CJ.
That's great, Paul. Thank you so much, and thank you for leading our tax department. And all this stuff ultimately finds its way on the tax returns, so that's going to be fun next year. Thanks for leading us through that, Paul. Go ahead and advance. As you see across the top here, what matters most is the things that we need to be doing as business leaders all of the time. Now, what happens is doing what matters most really matters more, because as we've went through all these different things that are out here of great benefit and value to taxpayers, to employers, really, is because it's not taxpayers in this scenario, nonprofits are very much so involved in this process. It is employers, is integration of these. So the EIDL and the Triple P, find a way, as we've talked about extensively, spend to compliance and then deploy to the margin after that. Don't just assume that I need to get 100% forgiveness on this loan. Go ahead and go to the next one for me if you don't mind, Ben. So part of working capital here, we've got these consolation prizes. If you're not eligible for the Triple P and or you don't have forgiveness for the Triple P, look at the retention credit and the payroll tax deferrals that Paul just went through. Make sure we build that into your payroll tax deposit process. These expanded tax provisions, generally speaking, faster timing of deductions and deferral of payments. Go ahead and spin all the way across there for me if you don't mind, Ben. FFCRA, as we look at either the post and comply or post and promote methodology, we talked about the wonderful ability for certain employers to take these credits. It is a thing that must be integrated. If you're eligible for these credits, I cannot stress it much. You, generally speaking, all employees are usually not 100% utilized. So to the degree that there is underutilization that's out there, find a way to integrate FFCRA into that process. If employees, unfortunately, are less than or equal to margin, neutral, basically they're costing us money when looking at our compensation paid to them versus the revenues. After dealing with compliance, consider these expanded unemployment benefits. They are a great, great process to integrate into the plan. And then, of course, given constraints and or performers, find ways to make them whole as a business. That also can help with the compliance aspect versus the forgiveness aspect. Keep in mind, integrating all these different things together is a somewhat of a work of art, but we can do this. And that is my thought here is if we follow this master blueprint, we put ourselves in an amazing situation. So concise call to actions here. Apply for the Triple P if you're eligible ASAP. The funds are probably going to run out. Well, we know they're going to run out. The question is how quickly and if there will be more. So get on top of this, watch the video, talk to your banker, ask your bank if they're not doing it, they'll refer you to someone. If they do not, reach out to your CPA. We've found some folks that are out there that are willing to work with newer clients of the bank. Deploy to margin. We've talked all about that. Every decision today needs to run through that. It always should be as a what matters most model. You've got to be looking at the bottom line and the incremental increase. But today, when you do that and you integrate CARES and FFCRA into those first 2 points is spectacular. The potential benefits that the government has put out there for us, make sure we're taking advantage of those in the days ahead. Know your 90-day cash flow plan. This is so important. In our toolkit, we have a great write-up Larry did, as I mentioned earlier, around liquidity. Please study this. Come up with a 90-day cash flow plan. Be prepared for the constraints on cash flow. This is not a 2 or 3 or 4 week process. This is going to last for some time, and even as we come out of it, we're hoping it's going to be like a rocket ship, but it's just going to take time. If we're at 10 or 20% unemployment, that doesn't turn on overnight. It takes time to ramp back up, to turn these things back on. Develop that emergency action plan if unsustainable and there is no path to the margin, okay? Be prepared, lastly. It is really important in today's world. I was listening to a program the other day about the hot hand, and it was talking about the night that Steph Curry went out and set the record. He missed the bus. He was on his normal routine was off. He never would have thought he was going to score the most points that he ever had in an NBA basketball game, but he did, and it wasn't because he had this routine that he stayed with. His routine was broken. it was because he had been preparing his entire life for that. And so I think my call here on Prepare is put in the time, put in the energy. If you're a leader right now, you should be working more diligently and harder and putting in the preparation more than you ever have in the history of your career, because this is one for some clients. For some clients, it is not this case, but for many clients, it's one of the most significant seasons that they will ever encounter as a leader. It's imperative that not only do you make the right decisions, but as you proceed in the days ahead, that you integrate what matters most and then find these other opportunities to make it matter more by taking advantage of all the things that have been put out there for us. So lastly, I just want to thank everyone for, one, being a client that we are blessed to serve. Without our clients, that's what we exist for, is to serve our clients here at Blankenship CPA Group. So thank you for trusting us. Thank you for allowing us to serve you. Know that our prayers and our thoughts are with you. We are here. We are available. We are prepared. There is just a huge amount of information on our website. If you go to bcpas.com and news, again, ask for copies of this. Blueprints forthcoming from your CPA. Ask for those. Develop the plan. Be prepared. Take action and see it through. And then just lastly, you know, our normal relational model has changed. Feel free to go online and give us if you're happy with us, give us a nice positive review on Google or Yelp or the Triple B. But if there's something that you want to talk to us about, reach out, and we would be glad to lean into you and help you during this period of time. We are so grateful for you as our clients, our friends. As my friend Hugh said, it is you guys who have raised our families over the years. So thank you for allowing us to serve you. And may God bless you and keep you, cause his face to shine upon you, give you peace and rest, and let you move forward in faith, not fear, in soundness of mind in the days ahead. Thank you so much. We appreciate you. Take care.